This is Nightly Business Report with Tyler Matheson and Sue Herrera.
It's the economy, how the raucous tone of the presidential campaign impacts a key issue this election cycle.
Checking in, a major Chinese company is making a big push into U.S. real estate, and it's hungry for American hotels.
At a crossroad, two companies, two CEOs returning from medical leave, and lots of big hurdles ahead. All that and more tonight on Nightly Business Report for Monday, March 14th.
Good evening, everyone, and welcome. A new survey tonight shows that the chaotic presidential campaign trail is changing the way people feel about the economy, and not for the better. According to CNBC, the current political climate is negatively impacting the outlook for the American economy, which includes everything from taxes to jobs to foreign trade. And these forecasts are something investors are watching closely, since the economy only grew at 1% in the final 3 months of last year. Steve Leisman breaks down the results of the survey.
Some interesting results from the CNBC Fed survey. In this presidential campaign season, we asked a bunch of political questions, and what you see is that of 42 respondents, including economists, analysts, and fund managers, 56% say the campaign itself is negative for the economic outlook. 5% say it's positive, and 39% saying it has no effect. As for party choice, which party winning would be best for the economy, 18% say Democrats, 40% say Republicans, but a large 42% here say it doesn't matter or they're not sure. That's higher than we've seen in other surveys. How about the candidate who would be best for the economy here? 0% say Sanders, 8% Rubio, 11% Cruz, 13% Trump, 16% Clinton, and 42% Governor John Kasich is seen as being best for the economy. How about best for Wall Street? Again, similar results here. 11% for Rubio, 0 for Cruz, 14% for Trump, 22 for Clinton, and 35 for Governor Kasich. You can see here again, Kasich loses a little bit. Clinton gains it when it comes to the stock market. But again, Clinton in that number 2 position, Kasich number 1, and Trump only number 3. Unclear in this anti-establishment, anti-Wall Street campaign if candidates wear this as a badge of honor or the other. You can imagine Sanders crowing about the idea that 0% of our respondents see him as good for the stock market or the economy. Back to you guys.
Steve Leisman reporting. John Harwood covers Washington and the campaign for us. Good evening, John. Is it possible that the harshness and the unruliness of the campaign, as Steve just described, is actually unsettling people as they make economic or investment decisions?
Sure, it's possible. Look, markets don't like uncertainty. And one of the things that we have is a Republican Party that's been torn apart, and the prospect of a Republican nominee who takes a position antithetical to traditional Republican positions on issues like trade, like entitlement reform, and immigration.
So that begs the question, can anyone really stop Trump at this point?
Yeah, well, we're going to find out tomorrow, Sue. You've got jackpots of delegates available in both Ohio and Florida. Those will be apportioned on a winner-take-all basis. Marco Rubio is trying to stop Donald Trump in Florida. It does not look like he's going to be able to. He's way behind in the polls. But John Kasich is running ahead of Donald Trump in Ohio. If he can hold that crop of delegates, that will make it more difficult for Donald Trump to get the majority he needs to be nominated on the first ballot in Cleveland.
Two questions in one here. What happened to Trump's lead in Ohio? He had one not long ago. And second, if Rubio loses Florida, do the so-called establishment Republicans want him to drop out?
Well, as far as Rubio goes, there's some debate about that, because if Rubio drops out, his delegates might be released, and that would allow Donald Trump to potentially get some of those ahead of time. So the more votes that are held and possessed by candidates not Donald Trump, the easier to deny him a majority. In terms of Ohio, John Kasich is a popular governor. He was recently reelected easily. The fact that Donald Trump is competitive with him is a sign of how strong Donald Trump's candidacy is. But John Kasich is a popular politician, and it's no surprise, really, that at the end of the campaign, he's going to exert some of that underlying strength.
We haven't mentioned Bernie Sanders. What are the chances that Mr. Sanders could pull another surprise and top Mrs. Clinton, as he did in Michigan last week?
The polls, Sue, were way off in Michigan last week. when we read the polls now, they say that Bernie Sanders is well behind in both Ohio, in North Carolina, and also in Florida. But he's hoping to pull an upset. The challenge is he's way behind in pledged delegates, and he needs not just victories, but big victories in order to make up that delegate gap.
John Harwood reporting tonight in Washington.
On Wall Street, stocks closed mixed on very light volume as investors digested deal news, looked ahead to the Fed meeting this week, and mostly brushed off lower oil prices. The Dow Jones Industrial Average added 15 points to 17,229. The Nasdaq rose fractionally, and the S&P 500 lost 2.5. Oil prices fell as Iran dashed hopes of a coordinated production freeze anytime soon. Domestic crude settled down more than 3%. And as for oil stocks, they have racked up some big losses over the past year. But believe it or not, they've also come back a lot in recent weeks. Morgan Brennan drills down on the energy sector.
Energy stocks may have turned a corner. The sector is outperforming the broader market, up 2% so far this year versus the S&P 500's 1% decline. Thank the recent rise of oil prices, which despite losses today have jumped nearly 25% in the past month. Still, energy stocks have a long way to go. They're still down by a third since the end of 2013 when oil was trading closer to $100 a barrel, and down more than 40% since the bull market began back in 2009. Mike Kelly, an analyst at Seaport Global Securities, likes U.S. oil and natural gas producers, including Pioneer Natural Resources, Parsley Energy, and RSP Permian.
If you do get to $50 long term, these are companies that really survive and thrive, have no balance sheet concerns, and make a lot of money at 50. We're not going to, ascribe any value beyond that. We think that's maybe where your long-term price goes to, and those are going to be the names that have exposure to the Permian Basin, best oil basin out there in the U.S.
Dividends continue to be a focus as well. Since the start of 2016, 19 energy companies with market caps of $500 million or more have reduced or completely suspended their payouts, according to S&P Capital IQ. Yet many have been winners in the sector's recent rally. Anadarko Petroleum slashed its payout by over 80%, yet shares have popped nearly 50% since late January. And Diamond Offshore Drilling, which suspended its dividend altogether, has seen its stock soar nearly 40%. Analysts say rising oil means companies can begin to make money, or at least not lose as much. Coupled with steep spending cuts, and it's a cash flow story that plays out most quickly where the companies hit the hardest.
I think that was a prudent, financial move by these companies to just, shelf the dividend for the time being. And I think, the investors we talk with pretty much understand that, and we're happy with that.
But one group has not partaken in the run-up: independent refiners. Shares of Marathon Petroleum, Tesoro, and Valero have all tumbled since 2016's start, pressured by higher crude prices, lower margins, and broader recession fears. But peak driving season's just around the corner, and analysts say that could fuel gains for some of these names. For Nightly Business Report, I'm Morgan Brennan.
To merger news now, the private equity firm Apollo Global agrees to buy Fresh Market for more than $1 billion. The deal comes about 6 months after Fresh Market said it was looking possibly to sell itself. The takeover sent shares of Fresh Market up more than 23%.
A Chinese investment group wants to buy up U.S. real estate, and it's going after Starwood. Anbang made an unsolicited offer for the hotel chain operator, threatening a pending deal with Marriott. That sent shares of both Starwood and Marriott higher. But as Susan Lee reports, this bid is part of a bigger wave of Chinese companies acquiring U.S. assets.
Not one, but two multi-billion-dollar hotel deals led by the same Chinese company. Fresh off its 2014 purchase of the historic Waldorf Astoria Hotel, Anbang Group now has its eye on the operator of W Hotels, Westins, and Sheratons, the Starwood Hotel and Resorts Group. Now, back in November, Marriott had agreed to buy Starwood for close to $11 billion to build the world's largest hotel operator. But now Anbang is leading a counter bid along with Primavera and JC Flowers, offering more money for Starwood. And that's on top of a separate deal being negotiated with Anbang buying up Strategic Hotels and Resorts for close to $6.5 billion. Strategic owns 16 properties across the country, including the famous Essex Hotel right here in New York. The current trend of Chinese money buying into U.S. real estate, according to some, is an encouraging sign.
Given the volatility that we've seen in the global markets and in China in the last couple of months. Some commercial real estate investors had a loss of confidence of sorts of Chinese investment coming here to the States. But this is a real vote of confidence, not only in U.S. real estate, but also the strength of Chinese investors coming here as well.
2016 is expected to be a record year for Chinese mergers and acquisitions outside of China. Just 3 months into this year, and we're already sitting at $105 billion in deals and counting, according to Deal Logic. And that's basically the same amount that we saw in the entirety of 2015, which was the highest recorded in history for Chinese M&A. And it's not just going into real estate and properties. This year we saw GE selling off its appliance division to China's Haier Group in a $5.4 billion deal. Another high-profile China acquisition so far in 2016, China's richest man and his company Dalian Wanda paying up $3.5 billion for Hollywood producer Legendary Entertainment. Now, you may remember Dalian Wanda as a company that bought up theater chain AMC just a few years ago and then listed it back in New York. And who can forget the pork deal in 2012, which at the time was the largest Chinese purchase in the U.S. Shuanghui buying up Smithfields for $4.7 billion. And given the current conditions, it might be safe to say that we can expect more Chinese money chasing U.S. assets in the future. For Nightly Business Report, I'm Susan Lee.
Still ahead. Bad credit? No problem. The sign and drive sliver of the U.S. credit market that's making some investors nervous.
An update now on the investigation into the crash that killed former Chesapeake CEO Aubrey McClendon. Officials say his SUV was going roughly 78 miles per hour when it hit a concrete bridge earlier this month. Data from the vehicle's black box show that he tapped his brakes, but not in the 31 feet before the impact. Investigators found tire tracks, but no skid marks, and he was not wearing a seatbelt.
Two companies at a crossroad, Valeant and United. Valeant is one of the most widely held stocks by hedge funds. United, one of the most recognizable brands in the world, and both are facing mounting challenges. We begin with United, whose CEO is back at work today, 2 months after a heart transplant that followed a massive heart attack last fall. But Oscar Munoz can't ease back into his old job. As Phil LeBeau reports, he has some big tasks ahead.
It may look like business as usual at United Airlines, but at the company's headquarters, it's not a normal day. CEO Oscar Munoz is back in the office and immediately tackling a persistent problem at United: poor labor relations. In a letter to employees, Munoz wrote, "I have many priorities on my first day back, but at the top of my list is my meeting today with our labor leaders. I believe that together we can resolve our contract issues." Those issues, including the amount of a proposed pay raise, led more than 90% of United's mechanics to reject its most recent contract offer. When union members voiced their complaints at an analyst meeting in New York last week, some admitted they're optimistic about working with Munoz.
And he seems like he's a pretty decent CEO than what we had back in the past. But we hope he will do the right thing for us.
Oscar's saying the right things. We're waiting for the delivery.
If Munoz and United's unions can get on the same page, the airline could finally improve its performance. For years, it's trailed other carriers in on-time arrivals, customer satisfaction, and profitability. But that could change under Munoz, according to the co-founder of Southwest Airlines.
I'm a big admirer of the new CEO, Oscar Munoz. And from everything that I've seen him send out to his employees, manifests the same humanistic spirit that Southwest Airlines does.
If Munoz can improve United's performance, it could go a long ways towards resolving another issue he's facing at the airline, dealing with two hedge funds that are pushing for new leadership on the United Board of Directors. Phil LeBeau, Nightly Business Report, Chicago.
And now to Valeant, whose CEO, fresh from medical leave, faces numerous problems from debt to federal investigations. And its recently delayed earnings report is due out tomorrow. Meg Terrell runs through the challenges facing CEO Michael Pearson.
It's been 3 months since the streets heard from Valeant CEO Mike Pearson, and investors will be listening closely tomorrow for clues about the drug maker's future. Pearson returned at the end of February from a 2-month medical leave of absence. He's recovered from severe pneumonia and other complications, and now has his work cut out for him. Analysts say he needs to reassure spooked investors that the company has no more surprises in store. Valeant stock has lost more than 60% in the last year after a series of seemingly never-ending setbacks. Scrutiny over its pricing practices, federal investigations, accusations of accounting fraud, and finally, Pearson's illness. But even his return brought with it negative surprises. Valeant postponed its scheduled fourth-quarter earnings release and conference call and has said its official SEC filing on last year's results will be delayed even further. News of another federal investigation also came to light that day, depressing shares even more. Investors are now awaiting the outcome of a board investigation into Valeant's relationship with the specialty pharmacy Philidor, the source of investors' accounting questions, as well as a delayed 10K. The company says it's focused on paying down its $31 billion of debt, and in the meantime will make fewer acquisitions. Investors are also concerned that health insurers and pharmacy benefits managers will increase their pushbacks on covering Valeant's drugs. Analysts say what investors most want from Pearson's return is improved communication, and most of all, a smoother road ahead. For Nightly Business Report, I'm Meg Terrell.
GW Pharmaceuticals reports a successful phase 3 trial of an experimental epilepsy drug, and that is where we begin tonight's market focus. The British drug company has been testing a cannabis-based drug to treat children with severe epilepsy, and it reported promising results in curbing seizures. The company intends to seek approval from the FDA to sell the treatment in the U.S. The news sent shares of the company soaring more than 120% today to 84.71. 3D Systems, reporting better than expected earnings, said it has plans to expand into healthcare and automotive applications. Analysts had expected a steeper loss from the maker of 3D printers. Shares jumping more than 24% on the day to $14.39, best day for the company in 5 years.
Drug maker Lannet's is reviewing its sales forecast for the year as the company says it is currently seeing unanticipated market softness, and the loss of an unnamed key customer is also expected to impact its sales. Shares down nearly 5.5% to $21.19. Redbox owner Outerwall announcing today that its board has decided to explore strategic alternatives for the company. The company also said it is doubling its quarterly dividend to 60 cents per share as part of its plan to continue returning cash to investors and retiring debt. Shares of the company ending marginally higher during the trading day to $34.39 and then initially spiked in after-hours trading.
Fears are rising over U.S. car loan delinquencies. According to the Wall Street Journal, subprime auto loans overdue by more than 60 days rose to 5.16% last month, reaching the highest level in nearly 2 decades, raising concerns now about the health of the auto industry. Joining us to discuss what this means for the hot auto sector is Melinda Zabritsky, Director of Automotive Finance at Experian Automotive. Melinda, welcome. Good to have you with us. How worried are you about this rise in delinquencies for subprime auto loans, namely those that go to people with less than pristine credit?
Well, we certainly look at delinquency, and while there is an increase overall, we do, of course, see the increase in subprime, but we also look at the overall performance of the entire market. And yes, it is up, but from an historical standpoint, if you go back 10 years, we're still at lower levels for the entire market than we were even pre-recession.
How much lower? Because you know how these events sometimes unfold. You see the subprime issues start to kind of fester, if you will, and then all of a sudden you do have an issue. So where are we in terms of the range?
Well, right now, when we look at 60-day delinquency, for example, it's about 0.77%. So pre-recession, you would see it about 0.84%. And then when you look at the percentage of the total market that is subprime, it's about 24.5% of all auto finance is subprime. If you compare that to pre-recession, it was closer to 30 to 35%. So yes, we've been growing subprime, but historically, it's still at very low levels.
So, of all auto loans out there, prime, subprime, whatever, 0.77 are delinquent. Of all the subprime loans that are out there, as I understand it, what has got people's concern is rising delinquencies among those that are then packaged off and sold as bonds. Is the problem really concentrated in those loans, the ones that are packaged, or in all subprime loans?
Well, unfortunately, I don't have much visibility to what would be packaged versus what would not be packaged. But of course, where the delinquency does occur, it is going to be in the subprime population. They're, of course, going to have higher rates of delinquency. And we do see those rates rising in subprime. We spend more time looking at the total market from the average lender that has a very broad spectrum portfolio, and they balance the risk that they know is going to occur in subprime with then, of course, having stronger focuses in prime and that near prime population.
Any final thought here? We all remember the mortgage-backed securities that sort of vibrated through the financial system and caused such distress. Can you see that happening with these bonds that are backed by auto loans?
Well, not necessarily. It's, of course, a much different product. The average debt level is going to be considerably lower, especially when you're looking at subprime debt. Probably the average balance on those loans is probably $18,000 to $20,000, so considerably different versus, a couple $100,000 mortgage. Plus, of course, there's going to be residual value left on those cars, so when they do go delinquent, they're, of course, going to sell them at auction and still get $10,000, $12,000 back.
All right. Melinda, thank you very much. Melinda Zabritsky with Experian Automotive.
Thank you.
Coming up, why the entertainment industry wants to blur the lines between content and technology. South by Southwest started out as a music festival, but today it's much more. Some of the brightest minds in technology regularly attend this annual gathering looking for the next big thing. This year, it's the entertainment industry that's going high-tech to lure new fans. Julia Borston reports from Austin, Texas.
Content is front and center at South by Southwest, with virtual reality on display and content sharing startups like Anchor and Nomi generating buzz. And this tech-savvy scene is a valuable audience for traditional media companies as well. USA's Mr. Robot hosting this Ferris wheel and arcade. AMC turning this church upside down to draw attention to its upcoming launch of Preacher. And HBO's Silicon Valley plastered the town with signs for fictional company Pied Piper. According to the show's star, Thomas Middleditch, tapping into the tech world is increasingly important.
I think the industry is big enough that if everyone in that industry likes something, it's big enough to move the needle. Like, I think just so many people are involved in tech, being a startup or just working for a company or even in an office where it's kind of tacky, I think it applies to you in a weird way.
This Game of Thrones attraction from HBO drew over 1,200 fans in its first day. HBO investing in this attraction that uses technology to put visitors' pictures into the Hall of Faces, hoping people will share their photos on social media.
You're not only hitting that one influencer, you're hitting every single person that follows that influencer, and that kind of continues to have a halo effect. So it helps us to amplify our marketing message. We like to do things that are more tapping into the technology, which really speaks to this tech audience here at South by Southwest.
HBO, AMC, and USA are all looking to boost the social conversation, promoting their hashtags for Facebook, Twitter, and Instagram, and hoping to generate buzz on Snapchat as the line between entertainment and technology continues to blur. For Nightly Business Report, I'm Julia Borston in Austin, Texas.
And that does it for tonight. I'm Sue Herrera. Thanks for watching. We want to remind you this is the time of year your public television station seeks your support.
And we thank you for it. I'm Tyler Matheson. Have a great evening, everybody.